Now let's talk about the items which are not treated as cash or cash equivalents. So we don't say those are cash or cash equivalents. First is like the time deposit or certificate of deposit, to whom we call, but the originally maturity is over 90 days from the purchase date. So the purchase date is whatever is there, but original maturity is over 90 days, then you don't call that as a cash equivalent. So let's see a real world example of that first. Now there is the Amazon company or a similar large company with high cash flow invest a 1 year 365 certificate of deposit in Citigroup. So Amazon is having its money and they are depositing for 1 year with Citibank. So what will happen? The classification will be like this is an investment in marketable securities, right? Why we are calling it as an investment, not a cash equivalent? Because the original term was longer than 90 days. Originally it was issued for 1 year, so we don't call it as cash equivalent. The investment is not considered an insignificant risk of value change. Now because what happens is like cash is like which have the same value. If you have 100 rupees now, within 2 to 3 months the 100 rupees will have the same kind of value, but after 1 year it may be possible that that 100 rupee or $100 currency may fluctuate due to currency changes in a very significantly. So the insignificant risk of value change, if there is, then the item is treated as I can say cash equivalent. But here the change is for 1 year, so that is not a cash equivalent. The company can't access it quickly without a penalty if it fails the cash equivalent test. So basically this is the example of rationale to treat the certificate of deposits which are beyond 90 days as a non-cash equivalent. Now balance sheet, what happens? Balance sheet within this is shown as a short-term investment. Why? Because if that is a current assets, or long-term investment if that is a non-current assets, depending on its maturity date relative to the balance sheet date. So if on the balance sheet date, let's suppose balance sheet date is 12, I can say 31st December, and on that date the certificate of deposit is going to mature within 12 months. So if anything is going to mature within 12 months, you call that as a current assets. But if the certificate of deposit is going to mature after 12 months, let's suppose 24 months, or I can say beyond 12 months, then you will say this is not a current assets, this is a long term assets, or what we can call it as a long term investments. Now there is the next item to whom we call it legally restricted deposits, or we call that as a compensating balances, but they are restricted. Let's see the example of some real world company for it. So there may be a mid-sized manufacturing company takes out 20 million loans from Bank of America. The loan agreement legally requires the company to maintain 1 million minimum balance in the separate bank account as a collateral. Now this 1 million is a mandatory requirement. You cannot withdraw that money. If you cannot withdraw that, you cannot call that as a cash equivalent. Now the classification will be like this is a restricted cash. You cannot use that cash, and the bank's legal contract prevents the company from withdrawing or using the funds for general operations. Since the cash is unavailable, you cannot use the cash for spending. It is not cash for financial reporting purpose. You don't call it as a cash. Then what do you call it? You simply call it as a current assets if the related loan is a short term, or if non-current assets if the loan is for the long term, common for the plant expansion or others. So basically it will depend that for what term this has been taken. Again the same thing will apply if on 31st December you will see if the repayment for the loan is going to be like within 12 months. If that is going to happen within 12 months, you will call it as a current assets. But if this is beyond 12 months, then you will say this is not a current assets, this is a non-current asset. Now there are simple key takeaways here for compensating balance. The question is always, is the company legally forbidden from touching the money? You say yes, the legal restriction is there. You say that is a restricted cash. this is a separate line item, not a cash equivalent. And if you say the company is not restricted, just an informal agreement, you call it as a cash or cash equivalent, and you disclose in the financial statement notes. So you just write that as a note, but not a separate item.